Welcome to the Deep Dive. We're here to plunge into those topics that, well, might seem complex, but are really vital for understanding today's world. Our mission, like always, is to cut through the jargon, pull out the key bits of knowledge, and leave you genuinely well informed, maybe with a surprise or two along the way. Today, we are navigating the fascinating and frankly crucial world of corporate tax in the UAE. We're drawing our insights directly from the latest comprehensive guides and notes, the ones from November 2023 and January 2024. So our goal in this deep dive to give you a clear, actionable understanding of who gets taxed, what's exempt, how it all works, and importantly, the practical implications for you, whether you're in business, thinking about it, or just curious about global finance.
Yeah, and it's really interesting how these guidelines have been put together. Understanding them, it isn't just about ticking compliance boxes, is it? It's really strategic. It's about navigating the UAE business scene effectively, spotting pitfalls, and leveraging benefits, things that could seriously impact your operations.
Okay, so let's dive right in. The big question first. Who exactly is subject to this corporate tax? In the UAE, it mainly applies to what the law calls taxable persons. Now, at its core, these are usually juridical persons involved in a business. And what's a business? Well, it's defined pretty broadly. Vocational, commercial, industrial, professional activities, all that stuff. And here's a key thing. Business often sounds like something long-term, right? Continuous. But the definition here, it also captures short-term commercial activities. It's really about the conduct of a business. Then there's business activity. That's even wider. It covers basically any transaction or action that's part of that business.
Right, and just to make those terms super clear for everyone listening, a juridical person is basically an entity with its own legal identity, separate from its owners or founders. Think companies, corporations, partnerships recognized by law, your typical structures.
Sure.
A natural person, on the other hand, well, that's just an individual, a human being. Simple as that.
Okay. Now, here's something that I think often surprises people, especially when we talk about natural persons, individuals. The UAE Corporate Tax Law has some really specific exemptions. For instance, your salary, wages, other employment income. Generally not subject to corporate tax. That's a big one. And similarly, income from what they call personal investments. So things you do in your personal capacity, no business license needed, not considered a commercial business. That's exempt too. And also worth noting, income from real estate investments, also outside the scope for natural persons.
And this clarity around natural persons, it's quite deliberate. The policy thinking behind it seems pretty straightforward. The corporate tax system is really designed to focus on corporate income, on formal business income, not so much individual earnings or passive personal investments. It keeps things simpler for individuals and focuses the tax on regulated business ops, which I think makes a lot of sense.
Yeah, it does. Okay, stepping beyond individuals then, let's look at other types of entities that get exemptions. First off, government entities. They're automatically exempt. They don't need to apply or be listed anywhere.
Right, which reflects their public function.
Yeah.
Keeps things clean for administration.
Then we have qualifying public benefit entities. Now, these aren't just any nonprofit. They're very specific. They have to meet conditions in Article 9 of the law, and they need to be listed in a cabinet decision. The kinds of purposes are broad, though. Religious, charitable, scientific, artistic, cultural, sports, education, healthcare, environment, humanitarian, animal protection, even professional bodies, chambers of commerce, social welfare, too.
Quite a list.
It is. But here's the really critical condition. They must not conduct a business or business activity unless it's directly related to their main purpose.
Oh, okay.
This is basically to stop them competing unfairly with regular businesses that do pay tax.
Yeah, that makes sense. And the intention there is clearly about ensuring all the money, all the assets, they're used solely for that public benefit cause, not for personal gain for the people involved, beyond reasonable salaries or expense reimbursements. It's about keeping that public purpose pure, essentially.
Okay. What about investment structures? Let's talk about those. UAE domiciled investment funds can be exempt. And what's quite interesting here is this exemption can apply even if the fund is managed by someone non-resident outside the UAE. That's under Article 4.1.
That's quite flexible.
It is.
Yeah.
Shows an intention to attract funds, right? Also, pension or social security funds, they're classed as exempt persons. And their wholly owned subsidiaries can also apply to the FTA, the Federal Tax Authority, for exemption.
And this kind of targeted exemption, it really points to that broader strategy, doesn't it? Attracting investment and making sure specific types of financial entities, the ones important for economic stability, aren't unduly burdened,
Yeah.
fostering that financial sector growth.
Right. Okay, what about less formal structures, like unincorporated partnerships? Generally, these are treated as fiscally transparent. So what that means is, unless they actually applied to the FTA to be taxed as a separate entity,
Which they can do.
which they can do, yes. But by default, the individual partners themselves are taxed on their share of the income, not the partnership itself. The tax authority sort of looks through the partnership to the partners.
Got it.
Then you've got trusts and foundations. Now, if these have their own separate legal personality, in principle, they could be subject to corporate tax. However, the policy intent seems clear, not to tax them if they're just holding and managing assets for the benefit of individual beneficiaries, natural persons.
Yeah, and if we kind of zoom out for a second, this transparency for partnerships, this specific treatment for trusts, it feels very practical. It acknowledges the underlying economic reality.
Yeah.
Instead of just taxing the legal wrapper, it focuses on where the economic benefit actually ends up, which probably simplifies things a lot for people involved in those structures.
Okay, let's shift gears a bit. Let's talk about a concept designed to stop double taxation, which is always a worry for investors: the participation exemption. So, what's this about? Well, essentially, its purpose is to make sure that income, like dividends or capital gains from one company, isn't taxed over and over again as it moves up an investment chain.
Right.
Think about it. If tax was already paid on profits at one level, the system shouldn't really penalize you again just because those profits are distributed to a parent company, right?
Precisely. Avoids that cascade effect.
So for this exemption to kick in, there are several conditions. Let's just get the spirit of them. First, the investment itself needs to be subject to tax at 9% or more, or meet specific rules for entities like qualifying free zone persons. Those are entities in the UAE's special economic zones, often with different tax rules.
Okay.
Second, you need to be a significant owner, typically entitled to at least 5% of the profits and what happens if it liquidates. Third, the assets the underlying company holds. No more than half can be interests that wouldn't qualify for this exemption themselves.
Right. Prevents some structuring, maybe.
Possibly. And finally, for capital gains, you need to have held the investment for at least 12 months. It's all really about proving it's a genuine sort of long-term investment, not just a quick flip for tax reasons. So, for example, say your company sells shares in another company, makes a capital gain of, let's say, 90,000 dirhams. Now, if 70,000 of that gain had a related impairment loss you previously deducted, that bit isn't exempt.
Okay, makes sense.
But the remaining 20,000, that can be exempt under the participation exemption, assuming, of course, all those other conditions we mentioned are met.
And what's really insightful here is just how precise these conditions are. They're not random rules. They're designed to be pretty robust to make sure only genuine long-term investment holdings benefit. Stops it being misused for, clever financial engineering or short-term speculative stuff. It sends a clear signal about encouraging real economic activity.
Okay, moving to the practical side of things. How is corporate tax actually managed in the UAE? Well, it works on a self-assessment system. That means you, the taxable person, you're responsible for figuring out and declaring your own corporate tax liability. You file tax returns once a year with the FTA, and payments are due within 9 months after your tax period ends. That period is usually the standard calendar year ending December 31st. But, crucially, businesses can align it with their own financial year end. There's flexibility there.
And that 9-month window, that's actually quite generous, isn't it?
Correct.
Gives businesses a decent amount of time to get their financials together, do the calculations properly, manage cash flow for the payment. Seems quite pragmatic.
Yeah, it does. Now, for bigger companies, this next bit is genuinely significant. The tax group regime. This lets multiple companies, provided they have common ownership, be treated as a single taxable person for tax.
Consolidate.
Exactly. And the benefits, pretty substantial. Imagine filing one consolidated return, effectively ignoring transactions between group companies for tax purposes. That cuts down compliance work massively. Plus, it gives more flexibility in using tax losses across the different companies in the group.
That can be very useful.
Definitely. The main condition, though, is high common ownership. The parent needs to own 95% or more shares, voting rights, entitlement to profits of assets of the subsidiaries, and importantly, everyone in the group must use the same accounting standards, usually IFRS or IFRS for SMEs if revenues under 50 million dirhams. The parent company then basically handles all the tax stuff for the whole group.
Yeah, and looking at the bigger picture, this tax group regime, it's just a very common sense way to tax a consolidated economic unit, isn't it? Instead of treating every single legal entity in a group separately, which can create huge admin headaches and maybe even artificial tax outcomes, it looks at the group as one. Much more efficient, both for the businesses and for the FTA. It's an efficiency move.
Right. Let's talk expenses then. How are they treated for tax? The general rule is pretty standard. Expenditure wholly and exclusively incurred to generate taxable income is deductible. If you've got shared expenses covering both taxable and exempt income, well, the bit clearly linked to exempt income isn't deductible. Any leftover, unidentifiable part needs a fair apportionment.
State of practice, yeah.
But some expenses have specific rules, like interest expenditure. It's not deductible if you borrowed the money from a related party, and the main reason for that loan was basically to get a corporate tax advantage. So intent matters there.
An anti-avoidance measure.
Seems like it. And donations, generally not deductible if they go to entities that aren't those qualifying public benefit entities we talked about earlier.
Okay.
And this is a really practical point for smaller businesses, there's small business relief. If your revenue is below 3 million dirhams, you can choose this relief. And the key benefit, many of the specific corporate tax rules about deductions, like that one about donations, they just don't apply.
Oh, interesting.
Yeah. So that donation to a non-qualifying entity, normally non-deductible, it would effectively be allowed if you opt for small business relief. It really simplifies things for the smaller players.
That's a significant simplification.
It is. Now, just to quickly illustrate the interest deduction principle, not the specific numbers, but the idea. Say company C has an adjusted EBITDA that's earnings before interest, tax, depreciation, amortization, a common profit measure of 180 million dirhams. If their net interest expense for the year was 20 million, the maximum they can deduct is capped at 30% of that adjusted EBITDA. In this case, that cap would be 54 million.
Okay.
Since their 20 million expense is way below the 54 million cap, they can deduct the whole lot. The point isn't the numbers, it's just understanding there are clear limits.
Exactly. And that example, it perfectly shows that even deductions that seem straightforward, like interest, they come with specific calculations, specific conditions. It really underlines that businesses need to pay close attention to these details, to ensure they're compliant, but also maximizing the deductions they're legitimately entitled to.
Okay, so what happens when companies in the same group, the same family, do business with each other? That brings us to transfer pricing. And this is all about, fair play, the core idea. Transactions between related parties or connected persons have to follow the arm's length principle.
Right.
Which basically just means the prices, the terms, they should be the same as if the deal was happening between two totally independent companies acting in their own best interest. The whole point is to let the FTA check that profits aren't being artificially shifted around between related companies just to pay less tax overall.
Prevents profit shifting.
Exactly. And just to clarify who we mean, related parties includes owners, directors, officers, and people closely linked to them. Connected persons is a bit broader. It covers related parties, plus partners in an unincorporated partnership, and even trustees, founders, settlers, beneficiaries of a trust in relation to that trust.
And why is this so critical, not just in the UAE, but globally? Well, it's fundamentally about stopping companies from artificially moving profits to low-tax places to cut their tax bill. Yeah. By enforcing this arm's-length principle rigorously, the UAE is basically aligning with international best practice. It ensures fairness and protects its own tax base from, let's say, overly aggressive tax planning.
Right. So how do you actually apply this principle? You look at various things, comparability factors, like what kind of good or service is it? When did the transaction happen? What are the contract terms? And importantly, the economic circumstances, market conditions, competition, cost structures, all that.
The whole context.
The whole context. And while there are several specific transfer pricing methods used to find the arm's length price, one common one is the comparable uncontrolled price, or CUP method. Basically, you look for identical deals between independent companies. So let's take a quick example using the cost-plus method this time. Imagine Company B, a subsidiary, sells semi-finished goods to its parent, Company A, adding a 5% markup. But independent manufacturers doing similar things in the same market, they typically use markups between 10% and 16%.
Okay.
In that case, Company B's 5% markup wouldn't be seen as arm's length because it's outside that market range established by independent companies.
Makes sense. It's below the benchmark. And it's worth mentioning the UAE uses quite a detailed six-step risk framework to look at these controlled transactions. It ensures a really thorough analysis from identifying the economic risks in the deal right through to checking that the contracts actually match what the companies are doing in practice. It's a pretty robust system for ensuring genuine economic substance.
And in terms of documentation, businesses need to keep specific transfer pricing records. typically a master file covering the whole multinational group and a local file for the UAE operations specifically. Crucially, the burden of proof proving your transactions are at arm's length that lies with the taxpayer.
Right, you need to support your position.
Exactly. For intra-group services, services between group members, same principle, price them at arm's length. Although, interestingly, for pass-through costs, like one company paying an invoice for another group member, those are usually just reimbursed cost for cost, no profit added, if they're just acting like an agent.
Ah, okay.
And there's also mention of low-value adding services, which might get a simplified safe harbor treatment. Now, intangibles, things like IP, brand names, know-how, developing or licensing these requires really careful analysis. Often it focuses on the DEMPI functions, who actually does the development, enhancement, maintenance, protection, and exploitation of that intangible. The idea is to allocate the profit based on who performs those valuable functions, uses the assets, and takes the risks.
That's quite detailed.
It is. Then you have cost contribution arrangements, or CCAs. These are like joint projects where related companies share the costs and risks of developing something, expecting to share the benefits proportionally. And finally, business restructuring. If a group reorganizes itself, maybe changes its supply chain, and that shifts profit potential between related companies, that restructuring itself must also be priced at arm's length.
Okay.
Oh, and a quick illustration for intercompany financing. Imagine Company X charges its related party an arm's length interest rate on overdue payments after, say, 90 days. Why? Because that's what independent companies would likely do to cover the cost of funds being tied up.
Right, reflects commercial reality. And from a strategic viewpoint, all these rules, yes, they're detailed, but they clearly signal that while the UAE is very much pro-business, it's also serious about adhering to global standards for tax transparency and fairness. This is especially important for big multinational companies, and it ensures the tax system has integrity without necessarily scaring off legitimate investment.
Okay, let's shift focus now to businesses that aren't based in the UAE but operate here. A key concept for them is the permanent establishment, or P. Basically, a non-resident company is generally seen as having a PE here if they have a fixed or permanent place through which they conduct their business. It's about having a significant enough economic presence.
A foothold.
Exactly. For example, Company G, non-resident, sends employees here for a 2-year consulting job. If they consistently work out of a specific hotel or maybe a rented office for that whole time, that can create a PE. Or another example, Company B, foreign company, sets up vending machines across the UAE and maintains them regularly. That physical presence and ongoing activity, that can also be a PE. But just promoting or marketing stuff here without actually signing contracts, that usually would not be enough to create a PE on its own. And it's not just about physical places. You can also have an agency PE if another person here consistently concludes contracts or maybe negotiates the main parts of contracts on behalf of the non-resident company.
Yeah, and the underlying theme here, what's quite fascinating, is that focus on economic substance, isn't it? Rather than just the legal form. It's about assessing whether that physical presence or even a dependent agent creates a significant enough economic footprint to justify being taxed here, regardless of where the company is legally incorporated.
Okay, so what about the other way around? UAE residents with operations abroad and foreign taxes they might have paid. Well, a UAE resident's income from a foreign permanent establishment, so a branch overseas, might be exempt from UAE corporate tax, but only if they make a specific election to claim that exemption.
Okay, an option.
It's an option, yeah. But here's the catch. If you choose that exemption for the foreign income, then any expenses related to that foreign PE, they become non-deductible back here in the UAE. It's a trade-off.
Ah, so you can't have it both ways.
Pretty much. And naturally, any transactions between that foreign PE and the UAE head office or other related parties, they still need to follow the arm's length principle we just talked about. Now, you might also be able to claim a foreign tax credit here in the UAE for tax you've actually paid in another country, like, say, withholding tax on interest income you received from abroad. But here is a really, really important detail, one that can catch people out. If your foreign tax credit entitlement is more than the UAE corporate tax you actually owe for that period, any excess credit is forfeited.
Forfeited, so lost.
Lost. You don't get a refund for it from the FTA, it just disappears. This is a critical point for tax planning, and this is quite different from a withholding tax credit relating to UAE withholding tax, where any excess credit is refunded to the taxpayer.
That's a crucial difference.
It really is. So, just make it concrete. Company A has 10 million dirhams in taxable income. 1 million of that is interest from country X, where they already paid 50,000 dirhams in withholding tax. That 50,000 can reduce their UAE corporate tax bill. But say their UAE tax bill was only 40,000 dirhams, that extra 10,000 dirhams of foreign tax credit, it's forfeited. Gone.
Wow. Yeah, that specific distinction between how foreign tax credits potentially forfeited and UAE withholding tax credits refundable are treated is hugely important for businesses, especially those operating internationally. Understanding that nuance is key to strategically managing foreign income, avoiding losing potential tax relief, and basically minimizing your overall effective tax rate,
Yeah.
avoiding double taxation where possible.
So after all that, what does this all mean for you? We've taken quite a deep dive into the details of corporate tax in the UAE, from who's covered and who's exempt, right through to how large groups can manage their taxes, and that really critical importance of the arm's length principle for keeping related party transactions fair.
Yeah, and I think what we've seen is that the UAE's framework, okay, it's detailed, it's robust, but it's clearly designed with transparency in mind. It aims to align with international standards. It provides, hopefully, a predictable environment, encourages proper compliance, and ultimately, the goal seems to be fostering a stable and attractive place to do business.
And the level of precision needed, whether it's for that participation exemption or getting your transfer pricing documentation right, it really highlights that in this world of corporate tax, sometimes the smallest details can actually have the biggest impact on your final numbers. It kind of encourages you, doesn't it, to think critically about your own financial reporting and compliance approach.
Which I think brings us to an important question for you, our listener, to maybe ponder.
Yeah.
Given how significant these specific conditions and definitions clearly are, how might a company proactively build tax considerations into its core strategy? Rather than just waiting and reacting to the compliance requirements as they pop up, how do you get ahead of the curve?
The journey to being truly well-informed, it's never really over, is it? We really hope this deep dive has given you a powerful shortcut, a better understanding of a truly vital piece of the UAE's economic puzzle.